welcome learners to Manifested Publishers. My name is Mr. Dongo, a lecturer of economics. We are tackling August 2024, that is Economics August 2024, question 3. I want us to pick on the first question, that is Roman A. Outline 6 roles played by commercial bank in economic development of a country. Put it down. Outline 6 roles. 6 roles played. Outline 6 roles played by commercial banks, by commercial banks in economic development of a country. In economic development of a country. Number one is to understand what you mean by banks, and to be precise, commercial banks. When you talk about commercial banks, these are basically financial institutions, and we have what you call commercial banks. These are not governed by, government bank like the central bank, but they are actually assist in the implementation. They assist in the implementation of the monetary and fiscal policy. Some of the roles of these commercial banks ranges from creating employment to mobilizing savings. We also have giving loans for investment and many other things, so we can put them down. One, we say they mobilize saving. We know that they mobilize saving. They promote the habit of saving, the commercial banks. Number two, they give loans. Number two, they give loans. So we say they give loans. They give loans for, we say, for investment. They basically provide loans for investment. And three, very important, the create, we can see that in the economy that we are in, commercial banks basically create employment. We say create employment. Create. Number three, we say create employment. Create what you call employment. And hence improves. And hence improves the standard, what you call the standard of living. And hence improve the standard of living. Creates employment and therefore increase the standards of living. We can also say they create money, and hence they create money. That is what you call the credit creation. Create money, and hence facilitate. They create money, hence they facilitate necessary capital for investment. Facilitate what you call necessary capital. What you call necessary capital for investment. They basically facilitate necessary capital for investment. We can also say that through commercial bank, policies are implemented. Through commercial bank, they assist. Through commercial banks, policies to control money supply are implemented. So that is say they don't initiate, but they assist. We say they assist in the implementation, in the implementation of monetary and fiscal policy as another role. The assist in the implementation of monetary and fiscal policies. These are policies basically that are regulating the supply of money in an economy. We can also talk about what we call the facilitate trade. They facilitate, lastly we can say they facilitate trade by providing, by providing an excellent means of carrying out trade. An excellent means of carrying out trade. An excellent means of carrying out trade by offering payment, i.e., we can talk about i.e. offering payments through checks. Offering payments through checks. Those are some of the excellent means of carrying out trade. Excellent means of payment through checks. We also have EFTs. When you talk about EFTs, electronic transfer, those also facilitate trade. That you can work with somebody who is outside in another country and actually do trade, and payments are actually facilitated. So these are some of the ways that are, or some of the roles that are played by commercial banks in economic development of a country. So very important as a learner to look at you need to look at the roles of the central bank. You also need to touch on basically also the functions of the commercial bank. And you also need to touch on monetary and fiscal policy and monetary and fiscal policy and how they operate. That is how we go about that very question. We'll pick it on the next question, still on August 2024. That is question 3, but now Roman B. This is what the question says. Argue 6 cases for restriction in international trade. Argue, that is B, 3 Roman B. Argue 6 cases for, that is for, argue 6 cases for restriction international trade. International trade. Argue 6 cases for restriction in international trade. So 4 meaning advantages of restriction. We need to understand what we basically mean by restriction and what are the forms of restriction that we basically have. We know that we have tariffs as a form of restriction. We also have what we call embargoes as a form of restriction. Basically, this restriction I aimed at geared towards protecting the local industry so that we don't allow what is from outside the other countries, what is from other countries to come into the country. Why does the government enhance this restriction in international trade? We can talk about a few, then we put them on the board. One is to protect the local industry against unfair competition from the foreign countries. That is number 1. Number 2 is what we call dumping. And when you talk about dumping, this is where cheap and substandard products get their way into the country. So when you raise the tariffs, it becomes very hard to import such commodities into the country. We can also talk about, it can also protect from bad culture from getting into the country. One of the ways that culture gets into the country is through trade. When you allow trade from foreign countries into our country, one of the things that it does, it will also lead to transfer of such culture into a country. But we say that if we do that, we are basically improving export. And when we improve export, we reduce what we call balance of, we reduce what we call a deficit in the balance of trade. We improve our balance of trade. Again, one of the reasons why we also basically have restriction when it comes to international trade is to increase government revenue in terms of taxes. So we can put them down by saying protect, protect infant industries against competition from foreign countries. The second one, to protect strategic industry, strategic industries, to protect the strategic industry against competition, from foreign countries, against competition from foreign countries, to protect infant industry against competition from foreign countries. But we can also talk about protect against dumping of goods into the country, dumping of goods into the countries. This is where cheap and substandard products get their way. But we can also talk about the next. We talked about improve the balance of trade. Improves what you call improves the balance, what you call the balance of trade. Basically implying that more export, more export. When you have more export, then we reduce what you call deficit. Improves the balance of trade or reduces balance of payment, balance of payment deficit, meaning that if we protect that, then import is going to be less, and therefore we're going to have more export. Then talk about improves government, improves government revenue in terms of taxes. Improves government revenue in terms of taxes because local trade is going to be high. Then you can also talk about prevent bad culture, what you call the bad culture from getting into the country. It basically prevents from bad culture from getting into the country. And I did say that this bad culture will get as a result of allowing so much trade in the country, from allowing so much trade into the country. Then we can also talk a very good point. Prevent a country from prevent a country. We can talk about prevent a country from what you call from imported inflation, This is inflation, which is a persistent rise in the prices of commodity that is experienced in another country to come into the country. That is how important for government basically to come in and have measures, or restriction in international trade. Because if you allow massive trade, some of the dangers, like, for example, we're allowing dumping of cheap and substandard product in, the government revenue in terms of taxes going down because people are importing more. We also see aspects of our local industry and strategic industries going down as a result of competition not being there. That is argument for or in favor of restriction against international trade. We pick it on the next question. That is question 3, Roman C. And this is basically a calculation question. So we're being told that the following information represents the national income of a country, X in billions of shillings. So we're given a consumption function, and you're being told that the consumption function we have, that is 3C. 3C, we're given a consumption function to be C is equals to 20 plus 0.8 YD, 0.8 YD. Then you have T, which is taxes. Taxes is equals to 30 plus 0.1 Y. Then we have I, which is equals to investment, that is equals to 70. Then finally we have government expenditure, which is equal to 20. Then you're being told that G is consumption, C is the consumption expenditure, T is the taxes, T is equals to taxes, I is investment, G is government expenditure, G is government expenditure, what you call the government expenditure. Then you have YD. YD is what you call disposable, the disposable income. YD is the disposable income. So I is the investment. So required on this end, one is marginal propensity to save. One is the marginal, marginal propensity, CT to save, marginal propensity to save. And 2 is the multiplier. Very important. So we basically say that marginal propensity to consume plus marginal propensity to save is equals to 1. Marginal propensity to consume plus marginal propensity to save is equals to 1. How do we get marginal propensity to save? To consume, marginal propensity to consume. That we get from the consumption equation, from the consumption function. And we have the consumption function, C is equals to 20 plus 0.8 YD. So marginal propensity to save is equals to 0.8. Marginal propensity to save is basically equals to 0.8. So we get back to our equation where we're saying that marginal propensity to consume plus marginal propensity to save is equals to 1. So I have marginal propensity to consume as 0.8 plus marginal propensity to save that we do not know is equals to 1. Marginal propensity to save now is going to be 1 minus 0.8, implying that marginal propensity to save is 0.2. That is what you have as marginal propensity to save. The second question, we are told to find multiplier. The second one is the multiplier. We have multiplier. Multiplier basically describe how many times an investment or any other exogenous variable would be multiplied to arrive at the national income. So the multiplier basically is equals to 1 over 1 minus MPC. And we said 1 over MPC, marginal propensity to consume, 1 minus MPC is equals to MPS. That is the marginal propensity to save. So when you have 1 minus MPC is the same as MPC. Look at what you have at that point. How are we getting MPC? MPS, sorry, 1 minus that. So when you have this, we have MPS. So to imply that the multiplier, to imply that the multiplier is equals to 1 over 0.2, or you can say 1 minus 0.8. We can break this out. Just to make it simple for a learner. Times 10 to do away with the decimal. Then times 10 to do away with decimal. That is 10 over 2. So the multiplier, 10 over 2, the multiplier is 5. The multiplier is basically equals to 5 in that question. The multiplier basically is equals to 5. We'll look at the next question. If there is consumption expenditure, we'll look at the next, that is the consumption expenditure. That is the next question. Consumption expenditure. On the consumption expenditure, very important to understand or to know that consumption expenditure, in order for us to get that consumption expenditure, then equilibrium level of national income and the taxes. So basically, when you look at this question, this touches on the expenditure method, what you call the expenditure method of calculating national income, where we say that Y, which is national, and know that Y in economics stands for national income, is equals to consumption expenditure plus investment expenditure plus government expenditure. But for this particular question, we do not have export, neither do we have import. We can also have X, which is export minus import, but we don't have that. In this question, we have consumption plus investment plus government. So we come to this question to say Y. Y is equals to, we have those functions there. Consumption is equals to 220 plus 0.8 YD, 0.8 YD plus 70, then plus 20. So YD, this is where a lot of students miss it. YD, which is equals to disposable income, which is basically equals to disposable income. How do you get disposable income? Which is YD. YD is equals to Y minus tax, national income minus taxes. And where is our taxes? National income minus taxes. So YD, which we have there, we're going to have Y. Where the taxes is 30 plus 0.1 Y plus 0.1 Y. The negative affects the whole bracket. So Y minus 0.1, that is 0.9 Y minus 30. That is the YD. We have the YD is equals to 0.9 Y minus 30. So we bring it back to our equation. So we have the national income is equals to 220 plus 0.8, and then we open the bracket, 0.9 Y minus 30. Then we have plus, we can break this bracket in order just for us to have the consumption function. Let's break it alone and have the consumption function alone. We can have the consumption function alone, which you know that is 220. What do you have as 220? Plus 0.8 into bracket YD, which is that 0.9 Y minus 30. We break it down. We break that 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 down. So we break that down. That should be 0.9, 0.8 times 0.9. That gives us C is equals to 20. If you multiply that 0.9 times 0.8 times 0.9, we have plus 0.72 Y. Then we have 0.8 times 30, that is minus 30.8. Minus 30.8. Collect the like terms. The like terms is 30 and 220. So we're going to have for the consumption 220 minus 30.8. We get 189. So consumption is equals to 189. 189.2 plus 0.72y. That is the consumption function. So when we'll be looking for answer, we'll have a summarized consumption function. We'll basically be having a summarized consumption function. We get back to our formula. Y is equals to C plus I plus G. Y is equals to C plus I plus G. C plus I plus G. We solve that. We solve that. We solve that. We solve that. So we have the consumption. That is C is equals to 189.2 plus 0.72y plus investment. The investment we have as I is equals to 70 plus 70. Then plus government expenditure, which is 20. So Y was equivalent to that. Collect Y together. Collect the Y's together. Bring this one to the other side. So Y minus 0.72Y is equals to 189.2 plus 70, then plus 20. So what do we have when you less that? You have your calculator. You just have it there. That will be 0. We have 0.28y. You add, these are all positive, we add them. So 189.2 plus 70, then plus 20. Plus 70, then plus 20. We have 279. We have a figure of 279.8. In order for us to get y, which is the equilibrium national income, we divide both sides by 0.28, 0.28. So y, which is the equilibrium, 0 point divided by 0.28. Y, which is the equilibrium national income, y we have as 997. We can round it off to one decimal place, 0.1, or we can just have all number 997. That is the value of y. That is the value of y to one decimal place, or we have a whole number. And that is essentially, if you look at that question, that is essentially part B. Most of the time when you're given this question, you realize that you first of all get part 4. So that is essentially part 4. We've gotten part 4. And then we get back to part 3. Part 3, which is consumption expenditure. What is a consumption expenditure? Consumption function, we summarized, we had 189.2, then plus 0.72y. So what do we introduce? We introduce y, which is 997. So we have C is equals to 189, 189.2 plus 0.72 times 997. We can get that. We have 0. Just when you do that, so 997 times 0.72, so that will be 189.2 plus 717.84. So the consumption function or the consumption expenditure, then you had was 717.84 plus 189.2. So for the consumption function, we have 907.04, or we can have it as a whole number, 907. So this is part 3. A lot of time when you do this question, you realize that The very first part that if you're given this as 4, you'll first of all get the equilibrium national income. The equilibrium national income is 997, and the consumption expenditure, we come and replace the national income, and we get that question. One of the things that you learn with calculation, this is a pretty interesting area. If you can understand those calculations and understand them perfectly well, then they will take you a shorter time and score a lot of marks very, very fast. And that is how we approach that very question in August 2024, question 3, Roman C.